In the next couple of videos, we are going to learn about accounting for leases. And you'll find out that accounting for leases has a great deal of overlap with accounting for long-term debt in general. Okay, so lease is a contract where the owner of the asset, lessor, transfers the right to use the asset to another party, right, for a period of time in exchange for fixed payments in the end of each period, typically. Okay, so lease is a great way to acquire an asset without really taking the title. You legally do not own the asset, yet you get to enjoy the asset, you get to use it in your production, and so on. Right? So historically, it was a great way of avoiding recognition of the asset on your balance sheet, and as a result, also avoiding recognition of the liability on the balance sheet. And as a result, all your ratios like leverage and debt to equity ratio and return on assets ratio are going to generally look a little bit better. Okay, so accountants at some point, of course, realized and recognized that this is an issue, and accounting rules have been changing to basically account for leases based on the economic substance of the transaction. Okay, so let's understand conceptually how we think about accounting for leases, right? So many leases in substance, in economic substance, look very much like a purchase of an asset, right? For instance, if you have a non-cancelable lease that covers the whole useful life of the asset, and in the end you automatically become the owner of the asset, in economic substance it's equivalent to buying an asset. Okay, and therefore accountants are going to look through legal substance. The fact that you don't own the title is not going to be so important. What's going to be important is that you are taking the risks of ownership related to the asset, and as a result, that's going to be considered your asset on the balance sheet. Right? Remember, the definition of an asset involves ownership, and we think about ownership not necessarily in the legal sense, but in the sense whether the company takes on risks and rewards associated with the asset, right? So if I enter a long-term lease, say I lease a store in Hyde Park, and the area does really well, that's going to be great for me and for my business. If the area is not going to do so well, and I might not be able to cover the costs, for instance, of leasing, that's going to be my problem, right? So I'm taking some risks here, and I won't be able to easily get out of this lease. So that's when you're taking the risk of ownership, essentially, and that's when you're going to treat a lease as a purchase. Okay. In contrast, if you have a short-term lease, or lease can be sort of canceled at any time, however you want, then clearly you are not taking any substantial lease risks of ownership. Right? If the situation in Hyde Park doesn't look that good, I'm going to basically cancel it and open a store somewhere else, right? So that's not going to be treated as a purchase. I'm not going to show in this case the asset on my balance sheet. Okay, so this is conceptual consideration that we are going to apply, and accounting basically is going to depend slightly on whether we are dealing with so-called capital or financial leases, operating leases, or cancelable leases, right? I mean, cancelable and short-term leases are very straightforward. We never treat them as a purchase. We basically, treat them as a rental expense, and we don't have to talk about them much. But capital and operating leases are going to follow purchase accounting, but there will be some subtle difference between the two, which we will find out later. The difference is not so crucial from 30,000 feet standpoint, right? Both follow capitalization on the balance sheet. So next we will find out about capital leases, okay?